Hello there and welcome to this AS Business Studies revision webinar with me, Graham Pryor from Tutor to You, and the topic we're going to be looking at in this webinar is measuring and increasing profit. So I thought we'd start off by looking at possible or typical exam questions around this topic. You may be asked to calculate the net profit margin, you may be asked to calculate return on capital. Common questions include analysing or evaluating a method of improving a business's profit and or suggesting alternative ways in which a business could increase its profit. You also need to know the difference between cash and profit, as well as being aware of the difference between profitability and profit. So just moving on, let's look at profit and profitability. They are two completely different concepts. Profit is measured in absolute terms and is calculated by total revenue minus total costs. There is an alternative way of working profit out, which is total contribution minus fixed costs. However, profit is measured in absolute terms, whereas profitability, on the other hand, is the amount of profit made in relation to the size or turnover of the business. And this is a different measure of profit, really. It measures how efficient the business is at generating profit. In order to measure a business's profitability, we need to use something called the net profit margin. So we're going to look at that next. The net profit margin is simply a way of measuring how efficient the business is at generating profit. So to calculate it, we firstly need to look at net profit, which is the difference between total revenue and total costs. Now, the net profit margin is the percentage return made on sales. So to calculate that, we take our net profit figure, we divide that by the sales revenue, and we multiply that by 100. And that will give us our net profit margin, and it is expressed as a percentage. So we're going to look at an example, and this is very similar to an example that came up in 2010, I believe, where students were asked to calculate the net profit margin from some numerical data that was in the case study. And this question was worth 6 marks, and 6 marks because there are 2 parts to it. First, you have to work out what the profit is. Then you have to use the profit figure to work out net profit margin. And remember, you will not be provided with the formulas in the exam. You just need to know them. So the first thing we do is we work out our net profit, and that is our sales revenue minus our costs. So I've just added up the costs there, took that off the sales revenue, and that gives us a net profit of £8,360. Always show you're working out, because if you get some part of the calculation wrong, you may be awarded some marks if the examiner can see some evidence of understanding. For example, if you got that part of that net profit calculation wrong, then use the wrong net profit calculation to our net profit margin, your net profit margin is going to be wrong. If you just wrote down the wrong percentage, then you wouldn't get any marks. But if you'd shown you're working out, and the examiner can see, actually, you forgot to take off the other variable costs there, when working out your net profit, you can see how you've made a mistake, and therefore you will be awarded some marks even if your final answer is incorrect. So we've got our net profit figure, and from there we can work out our net profit margin, which is 8,360 divided by the sales revenue times 100. That gives us a net profit margin of 14.31%. And that is it. Very simple. Now we're going to look at another example which really illustrates the importance of profitability and what that percentage figure actually means. So we're going to look at two rival florists in the same town. Last year, Florist Gump made a profit of £18,000. Its main competitor, Austin Flowers, made a yearly net profit of £22,000. So on the face of it, we can see that Austin Flowers, in absolute terms, made more money. He made £4,000 more profit. Florist Gump had sales of £195,000, whereas Austin Flowers achieved sales of £260,000. Which business is the most profitable? Well, for that we need to find out the net profit margin. So the net profit margin of Florist Gump, net profit divided by sales times 100, gives us 9.23%. Austin Flowers, same calculation, gives us a net profit margin of 8.46%. Now we can see here that actually Florist Gump is more efficient at generating profit. What those figures mean is for every £1 of sales, Florist Gump achieves a net profit of just over 9p, whereas Austin Flowers, for every £1 of sales, they achieve a profit of just over 8.5p. So in terms of generating profit, Florist Gump is better. It doesn't make as much in absolute terms, but it is more profitable. Good. So now we're going to move on to return on capital. Now, return on capital looks at how much net profit or return is made on the money capital that has been invested in the business. Now, it can be used to ascertain the return on any capital investment. For example, the business might be thinking of investing in some new machinery, so the business could use the return on capital calculation to work out the return it would get on investing in that new machinery, for example, a new production line. The return on capital is calculated as follows: net profit divided by capital invested times 100. So we're looking at how much net profit the business makes in relation to the capital that has been invested in that business. So let's use our florist example. Florist Gump made a net profit of 18,000, as we know, in 2014. Its capital, the amount of money that was invested in the business, is 205,000. This gives us a return on capital figure of 8.78%. This means for every £1 capital that's been invested in the business, Florist Gump returns net profit of just under 9p. Now, this is a very useful calculation when comparing different investments. Investors might use this calculation to see which return is best. So they might look at rival investments, find out the return on capital figure, and then choose which business they're going to invest in based on which one's going to have the highest return. Now, we're going to look at methods of improving profit. Now, this is a relatively common question in Buzz 2, and that not only requires a good understanding of the different ways in which a business can make a profit, but also the different functional areas. Now questions on improving profit usually give a specific method to consider. For example, you might be given a question: do you think that the best way for business A to improve profitability is to reduce its prices? Or do you think that business B should increase its prices by 8% to improve the level of profit? How you answer a question like this is relatively straightforward. You should answer by providing an argument as to why that method is a good method of improving profit, and then argue against that method, which could actually be an alternative way that may be a better way of improving profit. Now, this requires a good understanding of the case study, because there will be information in there which will allow you to come up with an alternative way of improving profit that may be better than the one that is suggested in the question. Now, to improve profit, ultimately, you either need to increase sales revenue and or reduce costs. And the exact method of improving profit will depend on the business and also the information within the case study. However, methods of improving profit could include increasing or decreasing price. Obviously, that's going to depend ultimately on the price elasticity of demand. Labour productivity. An increase in labour productivity will lead to lower labour costs per unit and therefore lower unit costs. So increasing labour productivity will ultimately reduce costs. Managing capacity. Higher capacity utilisation will lead to lower unit costs. You need to understand how and why, but that is another method of improving profit. Promotion. Now, obviously, there will be a cost involved in promotion. However, if sales volume can be increased in excess of the amount spent on promotion, that's going to increase revenue and should ultimately result in improved profit. Now, it's probably useful to put this into the context of a case study. So I wrote a short case study for this webinar based on and it's a mini case study that is not dissimilar to the type of thing you might get in a Buzz 2 exam, and it's based on Lessiter's luxury chocolate and truffles. Now, you may not be familiar with Lessiter's, but it was a business founded by two brothers in 1911, and it remains one of the very few independent chocolate manufacturers in the UK. They specialise in luxury chocolates and truffles, selling at a premium price. And Lessiter's estimate that the PED, the price elastic demand for their chocolate, is minus 0.8. So it's relatively inelastic. What's interesting about Lessiter is that they don't use retailers. You can only buy their chocolate online or at a shop which is attached to their factory. Just some background information. During the recession, there's been a shift away from premium chocolate, but as the economy recovers, we've seen that this segment has achieved strong growth. One negative consequence of this sales growth, however, has been an increase in the number of faulty products, which has risen from 1.2% to 3.8% in the last year. And Lessiter has put this down to staff working extra shifts, overtime to cope with the increased demand. So we got some information there, and we've also got some numerical data here. So we've got the budgeted and actual revenues and costs for 2014. So we've got budget and actual. So we've got sales revenue. So we can see that sales revenue was less than budget. We've got some information on rate and rent. What's interesting is if we look at wages, we can see there's a big variance between what was budgeted and what the actual is. Now we can probably put that down to what we looked at earlier, which was probably down to there's been an increase in demand, and in order to cope with that increase in demand, the staff have been working extra shifts. So there's a link there between working extra shifts in order to cope demand and wages being higher than budgeted, probably because of the overtime payments. As we can see, that's had a knock-on effect, total costs being higher than budgeted, and which has also led to profit being adverse when compared to budget. So we've got a question now which is not dissimilar to what you might get in a Buzz 2 question. One of the directors believes that the best way to improve the profitability of the business is to start selling their chocolate through retailers. To what extent do you agree with this statement? So let's just have a quick look at some arguments for and against here. So got some reasons for. Obviously, selling through retailers possibly increases the chance of higher sales because it's in more outlets, so that could be a good way of improving profit. Greater awareness to a wider range of potential customers. Now, this is quite an interesting point, just needs a bit of explanation. If their chocolate is in more retailers, you may not necessarily buy them from a retailer, but you might say they were stocked in Waitrose, and you might go shopping in Waitrose, you might see a box of their chocolates. You might not buy them from the retailer, but it's going to increase your awareness that this product actually exists. So you might go on to buy a box of their chocolates online. So being in a retailer gives them greater awareness, which in turn could lead to an increased sales, not necessarily through the retailer, but also through their online shop. But let's look at some of the reasons against. So you could have this loss of exclusivity. So at the minute, you can only get them online or in their factory store. So maybe being in all these retailers, they're going to lose some of that unique selling point. That's probably an argument against selling through retailers. Let's look at some alternative ways, though, that the business could improve profit other than selling through retailers. Well, we know that the product's relatively inelastic. So therefore, raising the price will increase revenue. That's probably a very quick and easy way of improving profit, by just raising the price because it's inelastic. That should lead to an increase in revenue. Overtime has resulted in wages being over budget. This needs to be reviewed. If they can cut the overtime payments down, perhaps maybe employing maybe a few more staff. Yes, labour costs are going to go up, but labour costs, normal wages will probably be lower than overtime, which should reduce wages, which in turn should improve profit. So that's another alternative way of improving profit other than selling through retailers. Faulty products, maybe by reducing the number of faulty products, that would help boost profits. And there's a link there. There's also a link between the amount of wages being paid and the faulty products. It seems that the faulty products has increased because staff are working extra shifts. So we've got some alternative methods of improving profit over and above the one that was suggested in the question. Now, just the final bit of this webinar is you need to be aware of the difference between cash and profit, in particular cash flow and profit. Like profit and profitability are two completely different concepts. And this area has been examined a number of times with questions looking at whether a business should be more concerned about cash flow or profit. Now, the best example I used to use with my students is the use of a self-employed builder. Profitable businesses can run out of cash. For example, a self-employed builder might take on a loft conversion. It's going to take 3 months to complete. It's going to be a profitable loss conversion. It's going to make X amount of profit, but the builder has agreed that he will only take payment after the job's completed. So the customer's going to pay after 3 months, but the builder will make a profit. However, in those 3 months, the builder has to buy materials, has to pay bills, might have to pay wages. So basically, the builder's got a lot of outflows where the inflow is going to come after 3 months. So that could potentially cause cash flow issues. So we can see how in this example, yes, the loft conversion is going to be profitable, but it could in the short term cause some cash flow problems. So putting that in a bit more context, profitability is probably more important to a business in the long term. It's possible that many businesses can survive levels of low profitability or even periods of a loss. However, cash flow is a significant short-term threat. It's probably one of the main causes of business failure. If you run out of cash and you can't pay your bills, you are in serious trouble, irrespective of how much profit you are forecasting at the end of the year. So that concludes our webinar on measuring and increasing profit. I hope you found it useful. Thanks for joining us. For more help and support from fellow students, teachers, and also Tutor to You, you can follow the Buzz2 hashtag on Twitter, or you can follow Jim at Tutor to You, or you can follow myself at Tutor to You Grim. Thank you very much for joining us. Thank you.